Hello, everyone. Welcome back to The Final Bar. This is Dave Keller, the Chief Market Strategist at StockCharts.com. Thanks again, as always, for joining us on our Closing Bell show, unpacking the action of the day and connecting it to the long-term trend. I want to bring on my guest, Larry Pesavento. Larry, I hear you're just getting started in the industry, so congrats so far on your early start.
Yeah, I've been here. It's been this is my third month. I'm actually enjoying it quite a bit.
I'm joking. You've had a fantastic career, and really appreciate you taking some time to share a couple charts with us, talk it through. You sent us two charts, and the first one is an S&P index. What is this telling you?
Okay, this is a 1, 2, 3, 4, 5 expanding triangle, also known as a reverse point wave. That was called that by Wells Wilder back in 1993. He sold it as a standalone system, I think, for around $3,000. But it came right out of Gartley's book, H.M. Gartley's book, Profits in the Stock Market in 1937. That cost $1,500. It was called a T6 pattern. The T was for triangle and happened to be the sixth one. These were the patterns that Dr. Andrew Lowe studied when he wrote his book, The Non-Random Walk Down Wall Street, in 2002. And he proved that these patterns, not only do they repeat, but they are predictable within limits. And what I do as a pattern recognition swing trader is I measure these patterns in price and time to find a place where the market should be making a major top or bottom. What I'd like for you to look at today is the point between 1 and 2, 2 and 3, and 4 and 5. This is why it's so important. Those of you that like Fibonacci numbers, you'll probably like this, because the distance between 2 and 3 is exactly 0.618 of the distance between 4 and 5. And if you reverse the process, the difference between 4 and 5 is exactly 1.618 to the distance between 2 and 3. So it's perfectly mathematically symmetrical. If you look at the cycle thing on the top, this is basically from the work of Jim Hurst. It's basically a static cycle. I just wanted to show that there was 10 months between the major highs, and that's another one that you're looking at. You also see points 1, 3, and 5. That's known as a 1, 2, 3 drive to a top pattern. Linda Bradsky talked about it in Street Smarts. It was also done in Gartley's book and a bunch of other people. But it's a 3 drive to a top pattern. So you have many things telling you that on September the 13th, we had a major top, we believe, in the stock market, and we're getting ready for something, very, very nasty to the downside. Now, here's the fun part. I'm going to get 5 minutes with you folks, and it takes 10 minutes to make you a professional trader. So you're going to have to do some of this on your own time. So here's what you have to do for your homework if you really want to see if this stuff really works or not. Go back to January of 2000, right at the dot-com bubble, and go look at that pattern, and go back and look at this pattern, and you'll see, oh my gosh, that's the same pattern. Well, if that's the case, then that should have happened in October of 2007. And lo and behold, there's the same pattern. The ratios are a little different, but the patterns are there. And that's why you really want to pay attention to what's happening to the market now, because any close below 2820, that's about 100 handles from where we are right now in the S&P, or one tweet, whichever comes first. We get below 2820, you're going to be looking at a move somewhere around 2040. I'm talking about 800 handles, and sometime probably by the end of October, maybe the 25th of October, or maybe into early November. But this is what it looks like. History says that this should work. Maybe it doesn't. I don't know, but all I know is that I would not want to be long stocks faced with this pattern. It's very, very tough to be long in this type of a pattern. As you can see, every time the market rallies since September 3rd, somebody smacks it in the head. So I think we can move on to the gold chart now. And this is going back to the high that we made in August of 2011. The key point to watch here is the head and shoulders pattern that formed between 2014 and 2017. Again, you're looking at perfect mathematical symmetry. You can see the green pyramids that are there. That forms the 3 drive to a bottom pattern, exactly the opposite of what we just saw in the stock indices. It's the same type of thing. And if you measure the time between 2013 to 2014 to 2016, you'll see that that was mathematically, again, spot on, saying the bottom should have been the last week of December of 2015. And then I look at the ratios, of course. The first retracement, major retracement, occurred in December of 2016, when the market came down and stopped exactly at the 78.6% level, which is the square root of 1.27. And then you'll notice again over on the far right, we made another 78% retracement in August of this past year when the market hit 1165. Now, the key point here is where I've marked in blue there, where below 1460 is bearish. The reason why I'm saying that is if you look at the last correction that we had during 2019, the one that ended in July, that move was down just about $100 an ounce, and this is pretty much what we've had now. Any move below 1460 will tell us that a major top has been made in the gold market, and I think we'll go all the way back to probably around somewhere around 1350 to 1300, and then we'll see if the market can hold that level and move from there. Now, folks, I want you to realize that I am a technician. I don't read the papers. I don't listen to the news. I look at the price of the bars. If they go up, there's more buying. If they go down, there's more selling. It's that simple. I'm not an Elliott wave person because I can't count to 5. I can only count to 3. So that puts me at a little disadvantage. But with the ratios, proportions, and just looking at simple things that work relatively well, that came right out of Dr. Andrew Lowe's book, you get a pretty good idea of what's really happening in the market. So that's what we're watching here this morning. I don't know if we have time for any questions, but that's pretty much what I wanted to cover. I don't know if my time is up. I only had 5 minutes. And that's over that right now.
It goes quick, Larry. Yeah, I will tell you.
Well,
5 minutes very quickly.
Yeah, I only know 5 minutes, so I knew I was out of things to say. So that's
those were two really fascinating charts, and I mean, certainly you win the prize thus far in our early history of Final Bar of the most dire S&P prediction that we've had. But I totally see, and the mirror between what we're seeing now and what we saw in the top in 2000. That's a really interesting comparison. Larry
People should really go back and look at it and prove it to themselves. I think it would open their eyes.
Right. Larry Pesavento, thanks so much for joining, and would love to have you back down the road for sure.